Welcome again to our recording of the question we've been looking at for SBR September 2023 mock exam. In the first recording, we addressed Exhibit 1, A1. In the second recording, we addressed Exhibit 2, B1 and 2. We now move to C, which requires us to use the pre-populated spreadsheet together with Exhibit 3 and 4 and the previous answers that we got in Exhibit 1 and 2 to correct the consolidated statement of profit and loss and other comprehensive income as at 30th June 20X1. You are required to clearly show any adjustments made. There's a note: show all workings to the nearest 100,000 in Part C, and that is 11 marks. So before we look at the pre-populated spreadsheet, let's look at Exhibit 3. Exhibit 3 goes as follows. FCO acquired 80% of the ordinary shares of SCO on 1st January 20X0. At the acquisition date, SCO's administrative offices were found to have a fair value of 2.5 million in excess of their carrying amount, and the average remaining useful life of these offices was 20 years. During the year ended 30 June 20X1, SCO sold goods to FCO for 1.9 million, giving rise to an unrealized profit in FCO's inventory of 80,000 at the year end. Both FCO and SCO pay corporate income tax at 20%. Again, understanding what is happening in the scenario is critical for you to be able to address your answers correctly. So there are two scenarios given in this exhibit. The first is fair value adjustments. Again, from knowledge, you recall that where there's an acquisition, if it's 3, business combination requires that we use fair values. Questions usually give you book values. To change the book values, you need to bring in the fair value adjustment. Now, depending on what the fair value adjustment is, you also need to depreciate that fair value adjustment. Of course, unless it's land, then you don't depreciate. So hence the 20-year life they've given us there. So we need to depreciate this fair value. The depreciation is what goes to the profit and loss. So 2.5 million divided by 20 years gives us an annual depreciation of 125,000. We are reporting on 30th June, meaning our financial year started on which date? financial year started on 1st July, so that is a full year. So this 125 depreciation is for the full year. Depreciation is an expense, so it affects the profit and loss. Since we are looking at the profit and loss, we'll see what we're given in the pre-populated spreadsheet, where to take it, but to go under profit and loss. The second scenario given is goods sold to the parent by the subsidiary. Again, from your knowledge, you know that in the income statement, when there is an intra-company transaction, you eliminate the intra-company sales and intra-company cost of sales, as well as the unrealized profit. So we are told the unrealized profit here is 80 million and the cost of goods 1.9 million. Again, those affect the profit and loss. The sales you eliminate from the sales, the cost of sales you eliminate from the cost of sales, the unrealized profit you eliminate from the cost of sales. We now look at Exhibit 4. Exhibit 4 states that the draft consolidated statement of profit or loss and other comprehensive income has been prepared by adding together the income, expenses, and other comprehensive income, and FCO, LCO, MCO, and SCO. No further adjustments have been made other than to eliminate the intercompany sales between SCO and FCO. So they've told us the intercompany sales 1.9 has already been eliminated. So we are remaining with the unrealized profit. However, in each case, the relevant proportion of the subsidiary's separate profits and total comprehensive income has been allocated to the NCI. Do not forget corp tax. Both FCO and SCO pay corp tax at 20%. So let's now see the pre-populated spreadsheet which you are given. So that is the spreadsheet. That's the spreadsheet that you will be given. So we have to bring in the adjustments and prepare the corrected profit and loss and OCI. So we need to have a total somewhere this side, so that as we do the adjustment, these adjustments will filter to the totals this side. We need to have a column for each of the adjustments that we have done so far. You recall we had we had a working for hedging, we had a working for foreign translation and transaction gains and losses. We had also just looked at unrealized profits. So each one of those should have a column. So you're going to do your adjustments. So we have the columns there. At the end here, you need a total to add across. So you need your Excel skills to come into play. You need formulas this side because you want your totals to be adjusted as you do our adjustments. We want the final answer Okay, once we are done, we can now start bringing our adjustments. We had unrealized profits of 80. The unrealized profit, you subtract it from cost of sales. So take note, since we've got a negative symbol here, so it means we'll be adding. We also had okay, looking for this 900. We had this 879, which we rounded off to 900. This was an exchange gain. So in the profit and loss, the gain, exchange gain, will be added. Now that is being subtracted. Where again, this is profit, gain. the unrealized, we add, we don't subtract. What we subtract is the cost of sales. Okay. We go and check. We had a 41. We had a total the hedge is for the hedge we had a loss of $75,922, and we had a gain of $36,575. When you net off the gain and the loss, we get $41,377. So we go to the hedge column. The hedge column is here. The question says we round off. That is the hedge. We've got a fair value adjustment here. Okay, this has to do with the very first or second transaction we did. The fair value adjustment was 2.5. We depreciated that over 20 years, which gives us 125. So depreciation, we bring it under operating expenses. We also have tax. Now, when you have got a fair value adjustment and tax is involved, you compute deferred tax No, it's not deferred tax. Tax reduces our depreciation is an expense which reduces our profits. Since we missed the depreciation because we did not take into account the fair value adjustment, so that affected profit as well. Equally, the unrealized profits will also affect profit, will also affect tax. Our tax rate is 20%, so 0.2 times do the same thing. So we are pretty much done for those adjustments which relate to the profit and loss. We now move to those adjustments which relate to OCI. So our adjustments which relate to the OCI were the foreign translation on the opening assets and the closing assets, the fair value movements in these assets. We had a loss of 482.1 in the balances of the assets. Okay, I think we also had, we had goodwill. We had goodwill, exchange loss on the goodwill of 53. So this is a loss, and the other one is also a loss. So when you add the two losses, 482.1 plus 53. 482 and the 53, you get a total of 535.1. Now, do not lose sight of the various instructions that you've been given. The goodwill, remember, we calculated using proportion, meaning the goodwill only belongs to the parent. So, but the gains did not only belong to the parent, the other gains belong to both the parent and the NCI. So we need to treat them accordingly. I will now explain from the model answer. So you need to practice the spreadsheet. So under OCI, we bring our total gains. We've got a loss amount that may be, no, we've got a gain. The 531.1 is a loss. So to be negative, reducing the gain. So let's first verify our totals here. We've got 8865.6. Let's just quickly verify our totals. This total should not be picking from there. This total should be equals some. Okay. So equally, this total should not be picking from there. This total should be adding that to Okay, this total, okay, this total, the totals should not be picking from the other side. It's the adjustment we should be picking from the other side. Okay, so we've got 8866, 8865. This is rounding off. Differences. If we want to have that, we can just increase that. Now that we have balanced with the model answer, let's look at the OCI. So you subtract the OCI from there. Then you recall in the P&L that the profits for the year in the total comprehensive income should then be split between the parent and the non-controlling interest. So to do the splitting, we shall do that in the last recording, just to make sure that the recording is not too long, to make it easy to download. So this recording will end it here, and then we shall continue with the splitting of the profits for the year between the parent and the NCI. So we'll explain how to do the splitting in the next recording.